Hi everyone, it's Tara Kumar. I'm a professor of finance, and this video is going to be called Why Cash is the Worst Investment. And what I'm going to do is going to look at how the value of cash has evolved over time, and I'm going to use a image from a popular book called Stocks for the Long Run, written by Jeremy Siegel, and then I'm going to compare that performance to the performance of other assets, stocks, treasury bonds, gold, as comparisons. So let's set up the scene, right? So here's the figure, and as you can see, we're starting in 1801, and everyone starts at $1, okay? So what we're doing is we're thinking about what basket of goods can $1 buy, like 5 apples, let's say, okay? And then we're looking at that purchasing power in real terms, like the number of apples over time. And what you can see is that over time, for the dollar, we have been losing purchasing power. Whereas we could buy 5 apples, say in 1801, we can only buy about 5% of those 5 apples in modern times, right? So why is that? It's because of inflation. As the government prints money, expands the money supply, right? Each dollar is worth less and less. That's just something that's been a trend in modern time and over the last 200 years. And there have been bouts of inflation where it's been more severe than other times. And you can see, like in 1981, the late 70s, when we had a very hyperinflation in the United States, say 12% per year, that you see the dollar decreasing quite rapidly. Okay, so cash is not a great store of value. And many people hide cash around their house in order to have, they think that that's a safer investment, but it's guaranteeing you less and less value over time. So let's compare its performance to some other investments. Let's start with gold, okay? Gold is the next one up, okay? Now you can see here that gold did a good job at maintaining the value, right? And that's what we think of with gold. We think of it as sort of there's a limited supply of gold, so it's hard to expand the supply of gold quickly. It's easy to print money, but not easy to find large amounts of gold. And it did its job, right? A dollar could buy 5 apples, and it looks like $1 invested in gold would now allow you to buy 10 apples, or twice the purchasing power. Okay, and so that is functioning kind of as popular opinion would suggest. Now, there are 2 types of sort of debt instruments that have been around for a long time. These are treasuries. So U.S. government issues bills or bonds in order to help raise capital to finance themselves. Bills are short-term and they're less risky, but they have some exposure to interest rate risk and inflation risk, and we can see that investors demand a compensation for that risk and have earned a return, a respectable return. That dollar that could buy 5 apples can now buy 1,500 apples, right? They have 300 times the purchasing power today, that investment, than it did back in 1801. And treasury bonds, which are longer term in maturity, are going to have more exposure to interest rate risk and inflation risk. Therefore, investors demand a higher risk premium, and you can see that treasury bonds have multiplied your purchasing power by 1,000. So now you can buy 5,000 apples. Okay, that's pretty good, right? Especially considering that those are default free, right? As long as the government is able to pay the interest. So how does this compare to stocks? Well, stocks are a residual claim on assets and productivity. They get all the upside, right? They benefit from growth. And what has the US gone through? Tremendous amounts of growth. And you can see that $1 $1 of value, 5 apples, can now purchase 755,000 times that amount if it was just saved in the form of stocks. And so that's a tremendous difference across these different asset types in terms of their ability to help generate wealth for you over time. And stocks, being the riskier one, leave you with the higher return. So while folks think that cash is a great store of value, especially those that seem to be the most anxious, it's actually the one that's guaranteeing you the poorest return. And if risk is losing money, you're the highest risk is really holding cash. Maybe the lowest risk actually is the gold, right? But if you are willing to take on some risk, you can do tremendously better than gold. So Warren Buffett has commented on this too. I like to review Warren Buffett quotes, and this one is quite appropriate for this lesson. So he says, "The one thing that I will tell you is that the worst investment you can have is cash." Everybody is talking about cash being king and all that sort of thing. Well, cash is going to become worth less over time. And now you've seen the data to prove, now you know that's true. And good businesses are going to grow, right? That's what we said, and become worth more over time. How do they grow? They reinvest their profits, right? Or if they don't have good projects, they pay you a dividend and then you reinvest it in another firm, right? So there's always that reinvestment going on. And that allows for compounding of your wealth. So cash is a bad investment, and it's because it's not benefiting from compounding in the sense you're not benefiting from growth, right? You have a different kind of compounding. You have compounding in an inflationary sense, where you are actually losing value at an increasing rate, or exponential rate. Okay, that was another mini lesson. If you like these, please subscribe below, and I look forward to seeing you in the next lesson.